In this video, traders, we're going to look at how you calculate your maximum intraday loss, i.e. the point where you call it a day and you won't lose any more. Stay tuned. Hey guys, one for you day traders out there. So how do you calculate that maximum intraday loss? So this is not necessarily what you're going to lose every day if you have a losing day, far from it. Some days may be small losers, some days will be bigger losers, but you need to have a safety net there. And this is what this max intraday loss is. Every day trader should have this. It's basically a point where if you hit this, regardless of how good you think the day is, regardless of how fruitful the opportunities are, you close down and you do not trade for the rest of the day. And it is there as a protection. And the protection is so that you don't let one day do too much damage to your account. So this is very, very important for day traders to have, guys. You absolutely must have this if you are day trading, because otherwise you are basically trading and you're at risk of yourself doing the damage. It's not going to be the trades that do it. You're going to go on tilt and you're going to end up digging a big hole for yourself. Trust me, I've been there. You may well have been there yourself. Now you decide, hey, I will never let my loss go below this. So how do you calculate it? So I want to talk about from a psychological perspective and from a kind of monetary perspective, because they're two things that have to be kind of work in tandem, really. You can't just have one or the other. So the kind of logical way to look at it initially is to say, right, so how many days of drawdown will I accept? So how many days of drawdown will you accept before you really start to get frustrated, say? Now, is that going to be 3? Is that going to be 5? Is it going to be 4? What is that going to be? That number, again, is something that you know that if you have those amount of drawdowns or those losing days in a row, that things aren't right. You know, it's not an anomaly. It's not something that is just a blip. It's obviously you not in tune with the market or the conditions not being conducive to your setup. Regardless, you need to be taking a bigger break. So it's the maximum number of days, red days, before you'll pull back, you'll reassess and you'll change the way you trade. Whether that's reducing your size, whether that's just not trading, whether that's coming in, you'll do something more drastic. And we can talk about that in future videos. But you've got that in your mind now. So let's say, for example, that's 4 days. So 4 days, like maybe you can say, it's just purely examples. 2 days, fine. 3 days. The fourth day, if I'm losing the fourth day, then maybe you want to call it a week and talk about refreshing and resetting. So that's your first number. The second number is what percentage or dollar drawdown will you accept? So this might be, obviously it's going to be related to your account balance. It's going to be related to all sorts of things. And again, it's a personal thing. So you might say to yourself, okay, I'm happy to take a $1,000 drawdown, a $5,000 drawdown, a $20,000 drawdown, a $200 drawdown. The number is irrelevant, guys. It doesn't matter the order of magnitude. It's all very personal to you. You decide. What are you happy to lose in 4 days? Now listen, happy's not the right word for it, but what are you prepared to lose as part of the trading game over a 4-day period? Because the danger that I think people have is they start from step 1, which is, the max drawdown per day, and they don't extrapolate that out and think, well, what if I had 4 max in a row? How would that make you feel? They're like, well, I'm happy to lose, $2 grand a day. Okay, so how many days you happy to take a 10 grand hit? Well, no. Well, you probably have to be, because you're not going to stop after 1 day, are you? So we're reverse engineering this. So that's why we start with the number of days before we kind of step back, and then we work out the total risk on that 4 day, and simply dividing it by 4 or whatever. So for example, let's just use these numbers here. For example, let's say you're prepared to lose 5 grand over a period of 4 days. 4 days, your maximum loss per day is $12.50 per day. So the worst case scenario is you lose $12.50, you lose $12.50, you lose $12.50, you lose $12.50. If you're 4 days of max loss, and you are prepared to accept that. Are you going to be happy with that? Probably not. But the point is, it's not enough to trigger a shock of, oh, I didn't realize I could lose that much. Oh no, what I'm going to do now? It's a calculated worst case scenario pullback. You're not going to keep trading after that, and nothing can surprise you. Whereas if you very quickly, before we kind of move on to the next part of it, if you said, oh, I'm happy to lose 5k, I'll do 5k a day, then you're in a horrible situation where, let's say you dump 5k on 1 day, and then the next day doesn't go very well and you dump another 5. What do you do on day 3? You're down 10. That's more double than what you wanted. So on day 3, you're in a horrible position then, because you don't want to trade, you want to get it back. You really pinned yourself into a corner. But by doing this, then spreading it out over the number of days that you're happy to trade and draw down, is much easier. Now, this is going to be different for everybody. The number of days, some people may, depending on the strategy as well, some people may be happy to go longer, some people may be happy to go shorter, and obviously the monetary amount is going to entirely depend on the account size and what you're prepared to accept as a drawdown percentage-wise or dollar-wise. Now, that is the logical way to do it. We have to add an extra step in there, which is the emotional side of it. And the emotional side of it is, are you prepared to draw down $12.50 in the day and it not affect you the next day? So this is the final question to ask yourself, something that is looked over but is super, super important. If you can accept that and you can accept your loss there and you can go to the next day and you can just do your process and whatever happens, happens, and the third day and the fourth day, then that's fine. But many people get to this and go, listen, if I was losing this amount on day one, I'd be unhappy. If it was on day two, I'd be really unhappy. On day three, I may well be trading on tilt. And trading on tilt is when you're trading purely from an emotional perspective to get that money back. If that's the case, then this needs to be reduced. And you need to say, okay, well, what about, after 2 days of max loss, how will I feel? Okay, well, maybe it needs to be, for psychological purposes, we human beings, guys, sometimes no logic to this, maybe it needs to be under $1,000 a day. In this example. So you might say, right, okay, well actually my max loss is going to be $950 on the day. So it's less than what you allowed, but for your mind, you don't want to see a 4-figure loss on the day or 5-figure loss on the day. Again, order of magnitude depending on the position size and the account size you've got. So you're tweaking and adjusting not only for the logic-based things, so you're now within the parameters of logic saying, hey, I'm not going to risk more than $5 over a 4-day period. And I don't really want to risk more than $1 a day. So here we go. 950 is my number. Right, do I feel comfortable losing that? Yes, I'm comfortable with that. I'm comfortable after 3 days of that, still sticking to the process on day 4. Day 5 might get me off my balance, but we've already covered that. So it's a very simple kind of equation initially, and then it's just running it through your mind of how you feel. How do you feel on day 2 or day 3, having had the max drawdown stop out? And then running through and saying, well, if you accept that, fine. If it's going to make you trade differently, then you need to scale it back. And the final step, of course, is then to work out your position sizing, number of trades you do from that scenario, so you're not getting stopped out, within the first 5 minutes just by one rogue trade. I mean, if you've got a position size that's, $1,000 at risk, and all of us just doesn't go, the trade doesn't work, which they're not going to. You don't want to be maximum stopped out. So again, you can go one step further than that and help your trading plan and risk parameter size and go, right, I'm going to do 3 trades a day. If worst case scenario, if I get stopped out 3 times in a row, okay, so I can afford to risk $300 per trade, etc. You start to reverse engineer it in that way as well. So guys, that's a kind of a way to calculate your maximum intraday loss. I think that it works very, very well. The logical argument and the emotional argument, put them together and you come up with at least something which, when it comes, it doesn't feel like it's punching you in the gut so much. Whereas if you don't think about it and you don't accept it, when you do get that max loss, or maybe get 3 or 4, 5 days in a row, and that will come from time to time, it's going to, you want to be able to, stomach it, reset, recharge, and go back in and do the process and hopefully get it back relatively quickly and get that account equity back to new highs. So, all right, guys, take care. Whatever you're doing, keep the risk managed. I'll see you in the next one. Bye-bye.